Hello again, everyone, and welcome out to this Investing Mentorships presentation on Intro to Derivatives. The sound of the word derivatives makes a lot of people nervous and scared. Am I going to understand what a derivative is? Might even remember that from math, taking it in high school or college and thinking, oh, that's very complex. We're going to make it simple and easy to understand. Yes, options are derivatives. Yes, we like to trade options. Why? Let's simplify the process, and we're going to do that today. As always, we just want to remind you that we're going through live examples and analysis, but it's important you understand that you take control of your own investments. This is not personal recommendations for you. So, types of investments. We can invest in stock and we can buy stock, and we'll talk about that a little bit today. If you buy stock, the nice thing about that is you actually have ownership in the company. Now, this is quantified in shares. I can buy 50 shares, 100 shares, 500 shares, or what have you. There are set amounts of outstanding shares, and every company has a different amount. They're different sized businesses, different sizes of companies. They'll call them small cap or mid cap or large cap. That speaks to how big they are. Usually small cap companies are maybe less than a billion in market cap. That means if you add up the total number of outstanding shares times their share price, their value is less than a billion. When you get in that 1 to 10 billion, that's usually a mid cap. So again, it's out total number of shares outstanding. That means how many shares do they actually have? How many owners are there out there times the share price, and that gives you the value. And then finally there's large cap, and large cap are 10 billion plus in market cap. You have a portion, even if it's small, you have a portion or a stake in the business. So if I go out and buy 100 shares, even if there's 100 million shares outstanding, meaning there's 100 million shares out there owned by different people, I still have my portion. And I'm entitled to the earnings that that company produces. Now, I have the CEO and those individuals that are managing the business, they're working for the shareholders. They decide what to do with the capital. We can vote as shareholders on our opinion. Maybe we can vote on different things, but the managers get to decide a lot of that. So maybe they decide to reinvest. If it's a growth company, they'll often reinvest the earnings back into the business. If it's more of a value stock and well established, they might pay out the profits in the form of dividends. So let's think about stock ownership for a second. If I invest in Apple and Apple goes out and sells an iPhone, that money that they made, the profit, is above and beyond the expenses. That profit has to go somewhere, right? And as an owner of the business, I'm entitled to my portion of it. Now, it might be less than a penny per iPhone, of course, unless I own a big stake. But, if I own my 100 shares or whatever, they're making billions of dollars of profit. They're going to pay some of that out in the form of dividends. And they'll always list their numbers per share. So that they'll say, we earned $5 per share this quarter. What does that mean? That means for every one of their shares out there, say their share price is $200, they made a $5 profit per share. And then the owner, the ones that run, I shouldn't say owners because we're part owners, but the ones that manage the business, like the CEO, they might say, well, we're paying out a portion of this. We're going to reinvest some of these profits back into the business, and we're going to pay some of them out to our shareholders. And maybe they take $2 and they pay out $2 per share. Well, for every share I own, I'm going to get a $2 payment on the dividend payout date. So if I own 100 shares and they pay out a $2 dividend, I get a $200 payment to my account. It's pretty cool. You get a dividend paid to you because you are part owner of that business, and they're paying it out on a per share basis. You don't have to do anything to receive that dividend. It will be taken care of automatically by your online broker. So you own your 100 shares of Apple or whatever the stock is in your account. Every quarter when they pay out the dividend, this money that you're entitled to just comes in as a credit, as a cash payment to your account. So that's one form of ownership, actual equity. And stocks are often called equities because it's an ownership stake in the business. Now, let's look at an option. An option is not equity or ownership. These trade in contracts where one contract controls 100 shares of stock, and it comes with rights or obligations to potentially own the stock in the future. So you're telling me that if I own an option, I don't own the company right now, but it gives me the right to be able to own it at a future date if I choose to. And the answer is yes. It's the ability to buy the stock at a future date. Now, do we turn our options? Do we exercise our options and turn them into stock? Not most of the time. Most of the time, we're trading the option in and out. So we're going to buy the option when we think it's going to go up in value. And after it goes up in value, we're going to sell it back to the market and we'll profit the difference. It's a capital gain trade. It's looking to take advantage of a price move. If I buy an option for $2, that's a $200 investment. If it goes up in value and I sell it for $4, I now brought $400 back in. Well, if you buy something for $200 and you sell it for $400, what did you make in a profit? You made a $200 profit, right? The difference between where you bought and where you sold. So with options, we can trade them in that manner. We don't have to convert them into stock, even though they give us the right to do that. Usually we want to leave them as options and sell them back to the market at any point in time when we decide to do so. So let me give you an example that will make more sense here. Let's see how options are similar to real estate. Now, when you think about real estate, you've got to go through this process of getting a loan potentially and taking ownership. And once you have ownership, you get the keys to this home and you're really excited about that. And maybe it's an investment property where you're going to try to rent it out and generate income and so on and so forth. Or maybe it's a home you want to buy. But there's something in the real estate market called a lease option or the possibility of buying it. Let me explain. Let's say that a new development is going up and they're building all these homes out there. And you come along and you say, you know what? I think I want to buy a home there. I think I want to invest in a home. But I'm not sure about that. Maybe the home's not going to be finished for a year anyway. But I want a stake in the ability to own that home a year from now when it's finalized. And so I come along and, I'm the one building the properties and I say, well, we can come to an agreement. If you want the ability to buy the home a year from now, I'll give you that first right of ownership, meaning I can't sell this home to anyone else. You get the first right to buy it. But am I going to give you that right, that ability to buy this home without some skin in the game? Aren't you going to have to pay money for the option to buy the home at a future date? And the answer is yes. You might have your reasons. You might say, well, I don't want to commit yet because is there going to be a school going up in the area? I'm worried they're going to put a garbage dump next to this place. I want to know what it's going to look like a year from now. I want to know if home prices seem like they're stable and going upward. I want an option, but I'm not ready to make the full commitment. These circumstances would affect your decision whether or not you want to buy the home. But again, I'm not going to give you that ability to tie up this home that I'm building for a year without a premium payment. If you pay me some money for that right of first refusal, for that decision-making process, if I give you the rights to buy this home, what if the home goes up a ton in value and you still have the right to buy it at the agreed upon price down here? I'm going to feel bad about that unless you've paid me some money up front to give you that right. And that's called a premium payment. So we're going to come to an agreement. You say, well, I'd like the ability to buy the home, and maybe these homes are going for $400,000, and you say, I'd like the right to buy it at any point, let's say in the next 1 year. This says 3, okay, we've been talking about 1 year. You have the right 1 year from now to buy the home for $400,000, no matter what. You have the right, but you get to walk away if you don't want to. You have the option to buy the home. See, you have control over this home. You can exercise your right to buy it at 400,000, or you can walk away. You could even sell your option to someone else. You could have the ability to buy it at 400,000, and maybe you pay me some money, and then somebody else comes along and they say, "Well, I'd really like to buy that home." And they pay you even more for your option. See how you could sell the option to someone else and make a capital gain? Maybe you paid me 20,000 for the right to be able to buy the home, but somebody comes along and says, "I really want to buy that home. I'll pay you 40,000." So you could hand them the piece of paper that gives you the right to buy it, give them the right to buy it, and you made 20 grand because you paid me 20,000 and you sold that option to them for 40,000. Doesn't matter to me. Somebody has the option and I got paid 20,000 up front, and I'm either going to get 400,000 a year from now and they're going to take ownership of the home, or I'm going to retain the rights to the home. I still get to keep the 20,000 no matter what, right? This happens in real estate. This is a non-refundable deposit. You have the option to be able to buy it. But again, I'm not going to give you that option for free. So I'm making you lock in a non-refundable deposit. I'm making you pay for the option. So with respect to this example, this cost is known as a premium. In options, when we talk about stock options, the premium is what you pay for the right to be able to buy the stock. In this case, the premium is what you paid me for the right to buy the home. So maybe you paid $20,000 to control that home for the next year. You could sell the option off to anyone else between now and a year from now. You can, sit on that and so forth. Now, let's say that over the next year, developments go in, they're built and zoned, no garbage dumps, schools come in. You decide, okay, time to buy the home. You can exercise your right to buy it. You've got to come up with a loan or you've got to pay cash or whatever, but you get to buy the home. So you still have to pay me $400,000. That's the agreed upon value. In stock options, we call that a strike price. This is the price at which the deal is being struck. We agreed in the paperwork that you had a year to buy it for $400,000. You didn't have to pay more, you don't have to pay less. You decide, I want to go ahead with that. Why? Because home values have gone skyrocketing. This home is now appraising for $800,000. Do you have to pay me $800,000? No. You had the right to buy it. We had a contract. You had the right to buy it at $400,000 even though it's worth $800,000. So you get that right. And you're going to exercise that right, and maybe you turn around and again, sell off the house. Maybe you sell the option to someone else, whatever. You can do that between now and that 1 year. Now, in a different scenario, say the zoning doesn't go through, the school is not built, maybe a garbage dump comes in, you can walk away. What if this home value went down from 400,000 to 300,000 in value? And you don't want to buy the home. You get to walk away, right? You don't have to buy the home. You had the option to buy it if you wanted to. In either case, the developer, I get to keep the $20,000 premium. Whether you decide to buy it for $400,000 at the expiration date or whether you decide to walk away, that's up to you. You can exercise your right, you can let it expire. Either way, I get to keep the $20,000. But it does matter to me which one you do. If you buy it, you have to pay me $400,000 and I get to keep the 20 grand. If you walk away from the deal, I now own the home. It might have gone sideways in value, might have gone down in value, might have gone up in value, whatever. You could walk away. I get to keep the 20,000 no matter what. So that premium is paid. In the options market with stock options, that's really what option contracts are. They're derivatives. They are the ability to buy the stock at a future date. So if you see Walt Disney stock is trading at $100 per share, you could go out and buy it at $100 per share today, right? And if it goes up in value, you'll make money. And if it goes down in value, you'll lose money. You can go out and buy the stock immediately. Or you could say, you know what? I want to buy some time to decide. I'm okay paying 100, but I'm going to want 3 months or 1 year or 1 month or whatever amount of time. We can buy an option that has 1 month to expiration or 3 months or 6 months, all sorts of different expiration dates, but we can buy a certain amount of time at that we want to decide whether we want to buy the stock at 100. So with a call option, it gives you the right to buy the stock, not an obligation, but the right to be able to buy Disney at 100, no matter where it goes. But is someone going to give us that right, that ability to control Disney shares or Intel shares? Are they going to give us the ability to control those shares for a certain amount of time for free? No. Options cost money. So if we want to go out and buy an option, we have to pay premium to someone else. Somebody else is selling the option, they collect the premium. There's rights and obligations, just as with real estate. Somebody has the real estate property and can sell someone else the option to buy it. Somebody else may want to buy it. Think about the two parties here. So we could be on either side of the trade. Imagine this. You own 100 shares of Disney. Maybe you've been buying shares over time. Maybe your grandma passed it down to you, whatever. But you own 100 shares. Could you go out and sell an option? This is just like real estate, okay? This is just as if this were a home, only this is 100 shares of a stock. Can you go out and sell an option that gives someone else the ability to take that away from you? Sure you can. And if you sell that option, they're going to pay you some money, some premium. So if you own Disney shares and you go out and sell a call that gives someone else the right to buy it away from you, they're going to pay you premium. So you get a credit. Maybe they pay you $200 with the ability to take your shares away. But here's the beauty of it. If the stock goes up and they take your shares away, you get to sell it at the price you wanted, plus you get to keep the premium. If the stock goes sideways and they decide not to take your shares away, you still get to keep the premium and you still own your Disney shares. If the stock goes down a little bit and they decide not to buy the shares, you still get to keep the premium. In either of those three scenarios, you get to keep the premium. You still own your Disney shares if it goes sideways or down. If it goes up, you are comfortable selling it. You get to sell it at a higher price, at a good value to you. Everybody's happy. So that's kind of that. What I just taught you there is what we call a covered call in the option space. When you own stock and you sell an option. But think about the person on the other side. They were the one buying the option. They got the ability to buy Disney away if it went up. They get the ability to walk away from the deal if it goes sideways or down. Do they have less risk than buying the stock? Sure. If the stock's going for $100 per share, they're not paying 100. They're paying a small percentage of the stock's value. So think of it this way. Here's an example with T-Mobile. This is a stock that was just breaking out. This is one of our technical patterns that we teach in our technicals classes where you can use the chart to identify buy points. And here you can see a classic breakout pattern. We've got increasing volume as the stock has turned bullish and is breaking to new highs. So maybe you think T-Mobile is going higher. Currently, the stock is going for $72 per share. That's its share price. So let's consider a couple of scenarios. Number one, could you go out and just buy the stock? Let's say that in your asset column of your balance sheet, so you have in your brokerage account, you have some money sitting there available to buy something. And you have, let's say, $7,500 sitting there available to buy something, right? Now, we know that this stock is trading for $72 per share. So of that $7,500 of cash, could you buy 100 shares of the stock? The answer is yes, of course. You could. So if you decide to buy the stock, your cash amount goes down to 300. Why? Because you just paid 7,200 for the shares. 100 shares at $72 per share. So now in your asset column, you have $300 of cash, right? You spent 7,200, but you own 100 shares of T-Mobile stock. And is that a good trade-off? Well, apparently so. You wouldn't buy the stock if you didn't think it was a good trade-off, right? So think about your balance sheet. Think about your asset column. Think about the money you have invested. That's the trade you just made. You sent $7,200 away. Now you own 100 shares of T-Mobile US. Well, what's good about that? Well, maybe T-Mobile pays you dividends over time and so on. That's income. So if it pays you $500 in income this year, that's building wealth. And as it pays you dividends over time, that builds your cash reserves. If they pay out 500 in dividends over the next year, your cash goes from 300 to 800 and so forth, right? So there's value in owning stock. But you could also say, you know what? Rather than go through this scenario and buying the stock, what if, I'm not looking to just generate income and own shares. Maybe I'm trying to trade this capital. So let's say I have that $7,500 of cash. Let's say instead of buying the stock outright, I want to buy an option. So I want to buy the right to be able to buy the stock. Now here's the beauty of this. If the stock is at 72 and 100 shares would be $7,200, how much would an option cost? Well, as a good rule of thumb, different options will cost different amounts of money, but let me give you kind of a rule of thumb that whatever the stock, remember this, whatever the total stock value is, so we're buying control of $7,200 worth of stock, it's usually going to be in the neighborhood of maybe 1 to 10%, let's say. 1 being the low end and 10 being the high end of what an option would cost. So if you want control over this $7,200, what's 1% of 7,200? Well, 1% would be basically $72, right? So an option's going to cost between 1% to maybe as high as 10%. What's 10% of 7,200? Well, it's $720. I'm just trying to give you a sense of how much an option would cost. Now think about that. 1% of the stock's value, somewhere up to 10%. This is kind of the range of what call options might be going for. Now, why might it be 1%? Well, it depends on different factors. How volatile is the stock? If it's a low volatility stock, meaning it's really stable and doesn't move a lot, the options will be less expensive. If it's highly volatile, then the options will be more expensive, on the more expensive side. If you buy a short-term option, it's going to be less expensive, meaning if it's an option that expires a month from now or 2 months from now. If you buy a long-term option, like one that's that has a year to expiration, it's going to be more expensive because the more time you buy, the more control you have, the more money they're going to require that you pay for that option. I'm just showing you that the option cost will be somewhere in the range of maybe 1 to 10% of the stock value. So think about our balance sheet. We have 7,500 here. Well, let's just say that this option costs maybe, let's say, 3% or so. So 3% of the stock's value would be about $72 times 3, 216 if I'm doing that right in my head. So we're not paying 7,500 in cash. We are paying 216 of that. So 216 of it goes away. So now our balance sheet, we don't have 7,500, right? We'll do this in my head. I'm going to do it on a calculator. 7,500 minus 216. I could do that. That's not too complicated. 7,284. That's how much cash we have. And if you think about our asset column, our cash went down, but not by that much. See how if we bought 100 shares of the stock, boy, it took away almost all of our cash. Our cash dropped from 7,500 to 300, right? Here, it dropped by 216 bucks. That's not much. We still have a ton of cash. But what we also have is one call contract, meaning we have control of T-Mobile. It cost us $216. If T-Mobile stock goes up in value, we can still profit. Just as if we had bought the stock and we get to profit as it goes up, this call option is going to go up in value if the stock goes up. It's a derivative. Its value changes based on the stock price movement. And if we're buying a call option, we are what they call bullish. We are expecting an upward move in the stock. If the stock goes up, the call option goes up in value, and we still get to profit with a lot less money tied up in the trade. So this is a good example of why option traders exist and why we love options. It gives you the ability to control something for a fraction of the cost. You still have a lot of capital here. So you can buy other trades. You could even buy two contracts here. Instead of only buying 100 shares, which is all we could afford in the stock example, we could buy control over 200 shares by buying two call contracts. So now we have invested 216 times 2, which is what, $432 invested in the trade. We still have over $7,000 of cash available to use elsewhere. So we're gaining control over assets, but for a fraction of the cost. That's a good example of how derivatives work. Our value, these options are going to change in value based on how the stock is moving, and their value is derived from the stock. So I hope you've enjoyed this intro to derivatives. As you go into the options market, this will kind of explain, okay, we're not buying the stock, we're not paying the full amount for 100 shares of the stock. We're paying a fraction of the cost, somewhere in the range of 1 to 10% of the stock's value, and we're gaining control over that asset, the ability to profit from its movements and do those things, but for a fraction of the cost. Hope you've enjoyed it. Thanks for joining us here at Investing Mentorships. Have a great rest of your day. Goodbye, everyone.